Welcome back to the Protecting Homeowners Podcast. I'm Marc, Dann.
Welcome back to the Protecting Homeowners Podcast. My name is Marc, Dann. I'm joined again today by my esteemed colleagues, Whitney Castor, Andy Engel, and Karen Ortiz, who is our loan modification specialist and paralegal extraordinaire. And we're here to continue to bust myths about foreclosure in this episode today. We talked about several of those myths in the last episode. And in today's episode, we just want to keep going. And the myth that I would like to talk about and throw to the group is that you're not responsible for paying the bank's fees, such as the cost of foreclosure, property inspection, and other things like that. Is that true?
Well, yes and no. It kind of depends on the fee. So things like court costs, at the end of the day, if the foreclosure were to go through, yes, you'll have to pay those fees, including the cost of its what's called a preliminary judicial report, which is a title search and a specialized type of insurance policy. When we get to the fees and charges that the bank controls during its servicing process, yeah, most of those fees you are going to have to pay, things like property inspection, and the like. The one type of fee you will not have to pay if you pay off your loan or the property goes through the foreclosure process is the bank's attorney's fees, because that is not permissible in the state of Ohio, with one major exception. If you are in a foreclosure and you want to reinstate your loan, bring it current through paying off the defaulted amounts, the delinquent amounts, the bank can force you to pay the attorney's fees it has incurred to date. But that's an important distinction. That's only in the instance of a reinstatement where you're curing the back defaults. Otherwise, you're not paying. You do not pay the bank's attorney's fees if you pay off the judgment, which we call redeem, or if you sell your house during the pendency of the case to pay it off, or the property goes all the way through the foreclosure and sale process. Whitney, do you have anything else to add on that?
No, I would just piggyback on what you said, that unfortunately some of those fees are going to have to be paid. And the mortgage is what allows the mortgage agreement that was signed by both the borrower and the lender, permits those fees to be added to the loan during this process.
Karen, what about in the event of a modification? Would those fees, inspection costs and appraisal costs and legal fees, would they be added to the unpaid principal balance in a modification?
Yes, they would. Unless the only exception I've seen them taken off is if there's over excessive property inspections, such as more than once a week. We had one client where they were getting inspected every day, so we successfully managed to get rid of those, but they can do a reasonable amount of fees. Yes.
Well, and that leads to an important point. There is everything in good measure, and in fact, we've had a number of cases using the federal and state consumer protection laws that we brought against mortgage servicers who have overcharged people who are in default. For example, it's our view that if you inspect somebody's home and determine that they're living there, there's a car in the driveway and the TV's on in the living room, that you don't need to then inspect that property weekly or even monthly while that borrower is in default. Maybe every 3 or 4 months would be reasonable, But the certain insurance companies, I'm dealing with an insurance company at home, so and they're just as delightful to deal with as mortgage companies, I can assure all of you. So now I feel how you feel when you call me about the problem that you have with your mortgage company is now, because I feel outgunned with the insurance company. But in any event, they can't do things that are unreasonable or unfair under the contract. We had a case early on in the RESPA regulations when they were enacted in 2014, and it was a high school friend of mine, and his house had been in default for a few months, and they were inspecting his house. I'm sorry, they were appraising his house using a subsidiary, and this is, of course, the company known today as Onity. Yesterday they were known as PHH. Before that, they were known as Aquin. So there's the alias Onity firm. We'll call them alias Onity. They had a subsidiary that did appraisals. So they thought, well, we're gonna leverage our business here, and so they were paying their own subsidiary once a week to come out and appraise my friend's house. Now, he remained in default, and we didn't resolve his mortgage situation until months later. We sent a notice of error to at the time, Aquin, and they literally wrote a check for all those appraisals to us, even though he hadn't made the payments. They had never collected that money from him during that time. So every once in a while. But the point being that there's a limit to what these folks can do. And look, if it seems unreasonable, it probably is. And in fact, under the Residential Mortgage Loan Act in Ohio, Andy, you can fill in what the standard is exactly. But it's unfair in
anything that's unfair or deceptive.
Right. And I think that was very broad bucket. Very loose. Right. Loosely defined. So, anything that, as you said, is not reasonable or reasonably justified, I think falls under that. Right. The other problem that we've started to see develop, and I just had another call about this yesterday, is when we bring affirmative claims against mortgage servicers, they are trying to add their legal fees in defending those claims for their unreasonableness to the unpaid principal balance of the mortgage. Now that's talk about enhancing their own felonies. I mean, that's really what's happening here. Why not double down? You're going to get sued. Why not in the process of getting sued start adding your legal fees that you're using to defend your bad acts to the balance owed by the borrower. And here's what that mortgage contract says that Whitney referred to. It says they can expend reasonable expenses to preserve the property, but not to defend their bad conduct. And that's just absurd. But it is a new trend that we're seeing among mortgage servicers. So they're doubling down. And look, we have a number of folks that we've represented over the years who, we should probably start our own frequent flyer program, because their mortgage companies keep making the same or similar or brand new mistakes in servicing their loans. And we've had to sue those mortgage companies 2, 3, 4, 5 times now over the 16 or 17 years we've been doing this kind of work. And so don't put it past them to do that. That happens because servicing transfers and all the information doesn't get transferred. It happens sometimes just because the mortgage company is incompetent at doing their job. Andy?
I was just going to say that we look at all of these things in every case. We pay attention to, all of the charges. We get down into the details, and yet we also take a step back and look at the case from 10,000 feet as well. And I'm not sure that everybody out there in this legal field does the same.
How about another myth that we can move on from? Anybody else want to share a myth that they think that deserves attention today?
I think that's me. And that would be that every modification results in the borrower receiving a partial claim. And unfortunately, that's not the case.
First of all, Karen, can you tell us what a partial claim is? What the heck is that?
Sure. Partial claim is a non-interest bearing junior lien that sits at the end of on the property, and it literally just sits there until you either decide to sell or pay off your house. If you decide to pay off your house, it is due and payable then and there. And if you decide to sell it, it does need to get paid through the proceeds. So if you ever have a partial claim, it's important to remember that.
And just
are
go ahead, Andy.
I was just going to ask, are these applicable to all loans or just special types of loans?
No, they're not applicable to all loans. As of right now, they are applicable to loans owned by Fannie and Freddie, FHA, and hopefully soon the VA. The rest of the investors may offer partial claims. It just goes by their guidelines, which we won't know until we apply.
Well, and so let me just kind of even go a little bit more basic. Partial claim refers to the lender making a claim on your Federal Housing Administration insurance, so your mortgage insurance. And instead of paying, so the insurance is there to protect the investors in your loan in the event that you default. In order to avoid having to pay more later, FHA, as an insurer of your loan, has decided to create this program where if you're behind and your mortgage servicer can work out a modification of your loan that will allow you to become current again, and they can make the judgment that you're likely to continue to pay the loan for the remainder of usually the 30-year term, or they can even sometimes extend it to longer in order to make that modification work, that they'll essentially pay the investors some money. But the insurance company has a right then to subrogate the claim that they're paying from the borrower. And so the way HUD and FHA has set this up, and hopefully VA will soon set this up as well, is that they take a silent second mortgage at zero interest. And what I've found over the years of doing this is that sometimes people forget that happened. They'll get into trouble. They'll fall behind on their FHA insured or VA insured loan, because VA briefly had a partial claim process called the VASP program. And there's a great National Public Radio series about how screwed up the VA has been over the past few years, and how they've really made it very difficult for veterans who fall behind on their mortgage to save their homes, which is for a different story. But going back to the partial claim issue, they'll make that payment and then they'll wait for it to get paid later. So, but you'll go to sell your house or to refinance your house, and every month you're getting a statement from your mortgage company saying that you owe $212,000. Well, you go to close your refinancing on the property. They do a title search. They see that silent second mortgage, and all of a sudden, the amount they need to pay off in order to refinance your home is $250,000, because there's a $40,000 some thousand partial claim sitting on the back end, that silent second mortgage. So sometimes people are surprised. I hate to be the one to have to tell them that it's correct. But again, conservators do a better job of letting people know what their status is, because they do a better job with their statements. Absolutely. We just settled a case yesterday where our client came out of a bankruptcy, and he started getting statements saying that he owed zero every month for about 12 months. So he paid what he was asked, zero. And of course, then the next thing you know, the mortgage company foreclosed on him, and we had to defend that foreclosure. But at the end of the day, he just did what a normal consumer would do, and to send a statement that says 0 and then foreclose on somebody, we believe was an unfair and deceptive business practice. And it was a violation of RESPA, and it was a violation of RESPA because we then asked the mortgage servicer to correct it, and they refused. And at the end of the day, they actually forgave the $14,000 that he would have paid during that year, paid him some money, paid all our fees, and everybody went home happy yesterday, which is in the legal business is a rare is a rare day. Now, it's not money that I'm going to retire on or our client's going to retire on, but he got made whole. And what a great day that is when we can help somebody who due to really no fault of their own, got kind of walked into a bad situation. Now, if you start getting statements from your mortgage company saying that you owe 0, you might want to ask some questions, because if you think you still owe money and all of a sudden they're telling you don't, I mean, this is not the lottery either. So one of the myths is that, that this is like a lottery, and it's not. That's one we can dispel right now. In order to win these cases, you have to work hard. These regs are complicated. And accessing justice from a mortgage servicer is a time-consuming and difficult and expensive process. And so while there's fee shifting, and sometimes we can shift that burden onto the lender, it is still a process that requires some time and effort. Andy, you have a myth you want to? Yeah, go ahead.
Well, after that rabbit hole you just went down, Mark, you kind of cut off Karen about modifications and partial claims. Let's get her in there.
Yeah, let's go back to what we were taught. Yes, and then this is going to be a danger in this podcast going forward. I'm going to assure everybody that if there's a rabbit hole, I will go down it. Karen?
Yes. Well, gee, you should do my job because it's full of rabbit holes. All right. So with FHA loans, there is a partial claim available in the waterfall, but it is only for 30% of the unpaid principal balance at the time of your first default. So if you have a default and you successfully manage to pull yourself out with a modification, life goes on, 15 years later, oh no, disaster strikes again, you need another modification. You don't get 30% from that unpaid balance. You get 30% from the original unpaid balance, subtract what is the partial claim, and that's how much is left over and available. If the amount left over is not enough to bring the mortgage current, unfortunately, you will not be able to do a partial claim. You will have to do a modification, which then changes interest rates and reamortizes and all that fun stuff.
Are there situations, Karen, where you can do both a partial claim and a modification?
Yes, there are. That is specifically for the people who don't have enough partial claim room, but they have more than $1,000 available. Then the FHA is able to offer both combination.
But their kind of first go-to is to do the partial claim, bring you current, and you go on with your life.
Correct.
And particularly for people who refinanced or originated their loan since the pandemic, when interest rates were extremely low, preserving that interest rate becomes something that's very valuable, and you want to think about.
Correct. Because I have a FHA mortgage with a 2.25, and let me tell you, I will be selling plasma to make that payment.
Well, that's right. And for some people who fall behind, again, God forbid you get sick in America, and you might be losing your home because you get big bills and you can't afford to make payments. And the question is, or your dog gets sick, for God's sakes, the vet bills can kill you you sometimes it's just we put people in bankruptcies where they can catch that payment up and preserve that interest rate as opposed to seeking a modification, which is kind of upside down from how it was after the financial crisis when the federal government had a much more generous modification rule, and there was a lot of interest rate reduction going on during that time. Now, my understanding is, and correct me if I'm wrong, guys, the interest rates are set at the market rate for Fannie Mae, Freddie Mac, and FHA loans on a modification. Is that correct?
Yes. And the VA is also set at the market rate plus 0.5.
Right. So the market rate now is just under 6%, I believe, or just a little over 6%. So that's a big difference from 2%, 2% loan that a lot of people have. So you got to, and look, here's the thing: you don't have to figure this out for yourself. That's why we're here. And so, we have people that retain us to take a look and make sure everything's okay on their loan, basically do a checkup, to send a request for information to the servicer, review their payment records, compare them to your payment records. And then if we identify anomalies, we can send notices of error and establish claims against the mortgage servicer. Or if you think something's wrong, we can dive in and take a look and see what's there. But we also have people that hire us, even when there's not a foreclosure pending or an identified problem, but they've fallen behind on their mortgage, to help them make that application for a modification. Karen, how many thousands of modifications have you done in the years you've been here?
Oh, 5 years. And I don't know, probably 2 or 3. It's like, let me just tell you this. We get more modifications than we get denials.
Yep.
And that's because we do our homework up front and we ask you a million questions, mostly me. And I have to know everything about you and your financial situation. And these guys keep the ball in the air in the court while I figure out your numbers.
And it's both an art and a science. There requires some explanation of why you're in default. It requires a lot of math, and it requires, particularly for people who are self-employed or who have a side hustle that they're relying on to pay their mortgage payment, to provide a lot of financial data about that business that they're in. And frankly, the folks on the other side of that are not as sophisticated as we are. The folks that are looking at that information. So having Karen and Whitney and Andy to be able to explain to the lawyers for the mortgage company or the bank or the folks on the other end of the telephone how to do their job is also a valuable service that we provide to people. And again, the worst that'll happen if you call us to have a consultation, which we do for free, is that we will say it doesn't make sense. You don't need to hire us now, or we can make a recommendation about how you can do this yourself, or how we can be helpful in supporting you in doing this. What other myth? Is there another myth or two that we can dispel before the end of this? We have about 5 minutes left. Anybody?
Whitney, do you want to talk about the timing of a foreclosure?
Sure. So I think it's been almost a year that the Ohio Supreme Court issued a mandate that all foreclosures need to be wrapped up within 1 year from the date of filing. Prior to that, there was no guidance really from the Ohio Supreme Court, but I do know that all of the courts now in the state of Ohio are reporting back to the Ohio Supreme Court to let them know, where they stand with cases. And if the cases are over a year, then that's a ding on the court. So we're seeing a real push for courts to wrap foreclosures up very, very quickly. So it's why it's so important that if you're served with a complaint for foreclosure, that you talk to an attorney or talk to, and someone immediately, because that time starts from the date of service or from the date of filing, not from the date of service. So, if it takes 6 months to serve someone, it doesn't matter. It's that date is a hard and fast rule. I have found though, when we file counterclaims, some of the courts are coding the foreclosure cases a little differently, which gives us a little more time to litigate. But again, that usually is about a 2-year process. But no longer are we seeing foreclosures sit on a docket for 2 to 3 years.
Well, thank you. And unfortunately, that's all we have time for today. But thank you for joining the Protecting Homeowners podcast. We look forward to seeing you on the next episode. And if you have questions, email them to Ava at DannLaw.com, and she will make sure that we answer them on the podcast.